Good day, ladies and gentlemen. And today we're here to discuss and understand market randomness. Now, if you believe, as I believe, that the markets are completely random, they're made up of hundreds of thousands or millions of people, traders, retail traders, investors, banks, financial institutions, all making decisions. And all of these people are human beings. So therefore, markets are non-random, are random. Well, we can't predict, and that's why we really don't have black box trading systems that can just pick out isolated times, because the markets just do what they want to do. But there are certain times that the markets exhibit what we call non-random behavior. This non-random behavior can be seen in what we call trends, because markets can move uptrends, they can move downtrends, or they can move in a congested, undecipherable mess. That's the random part of the markets. When they move in this mess, they are completely randomless. At certain points, though, we start getting some non-random behavior. And these form trends. And when we see the formation of these trends, if we can think of it for that short period of time, all the people in the market are not making non-random decisions, they're not making random decisions, they're making non-random decisions. Okay. When these short periods exist, and the markets, we have them quite often, okay? They're all the time. Now, it's isolating or understanding the non-randomness that can help improve our trading. The quality of the movement is very, very, very important, because a market can move up and down, but it can move oh, come on, I'm just trying to get my highlighter on here. It can move this way, or it can move push, ease, push, ease, push, ease, push, ease. Okay. But it can also move that way. Okay. We can trade any of these, but the fact is, when we have a non-random movement, push, ease, we have the possibility of making intelligent trading decisions. Now, when we find these uptrends or downtrends, these well-qualified movements, we expect certain types of behavior. Okay. If we understand trends, this is a higher high and a higher low, a higher high and a higher low, a higher high and a higher low. Okay. As these are being exhibited, we can determine, okay, price is pushing up, it's going to ease back down. At some point, a lot of those traders out in the market reach their target points. They've taken their profit. Okay. And so they're selling out of the market. They're very happy with whatever they got. Other traders who are sitting on the sidelines said, oh, that price is a little bit too high for me to enter the market. They're going to wait for that price to ease back down, and then they're going to come back in the market. And that's going to start that up movement again, so that retracement then ends and the uptrend continues. Because remember, it takes a lot of people, a lot of investors, a lot of traders, a lot of movement and action to develop an uptrend or downtrend. So it's like a stone rolling and rolling and rolling and rolling. It can hit a bump, but it's going to continue down that mountain or up that mountain. The stone can go up a mountain. But we have to be able to determine which are retracements and which are reversals. Now, reversals are temporary changes in assets trend that occur over a short period of time. Oftentimes, reversals can last minutes, hours, or days. But if you're in the market, a reversal is the point in which you are going to determine to get out of the market. If you're, whereas a retracement is a healthy thing that takes place in a trend. So remember, you don't want to panic to get out of a market, but you want to understand how to find the difference, how to understand when that randomness or that non-random behavior is getting to be random again. So Wall Street is chock full of investment idioms, but perhaps none is so broadly quoted as cut your losses short and let your winners run. It's easier said than done, but how in fact is an investor know whether a stock or an asset is merely retracing against an existing trend, or if the trend is outright reversed? Successful investing is predicated on knowing the answer to this question. So I'm going to look at a chart, but really a chart of rules, but really it's not a help to any of us in short-term trading, because there is no definition or explanation after the fact maybe that we can be looking at to tell the difference. Telling the difference between a retracement and a reversal is an art. It's understanding the asset and how it moves. Whenever a price reverses, most traders and investors are faced with just a tough decision. Okay, we can hold on through the sell-off and hope it's just a retracement. We could sell and rebuy, or we can sell and permanently leave the markets. By properly identifying the movement as either a retracement or a reversal, you can reduce costs, loss, and preserves. So I'm going to take you over to some live charts and try to show you how this is done and how we analyze these price movements. Because keep in mind, retracements are healthy and reversals are dangerous, but they're also helpful in understanding our trading. And remember, retracements can move into reversals in the blink of an eye. So reversals are defined as a change in the overall trend of a price, so it's when an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a price. And you only have three choices. One, if the position, you could hold on and sit back. Two, you could close your position and re-enter when you've determined whether that's a reversal or a retracement. Or three, you could permanently close your trade. Now, if you're a smart trader, you have a set of rules for your trade. For me, I use a trailing stop loss, and as my trade moves into profit, I'm constantly moving that stop loss up and up and up, and I'm actually closing part of my trade in profit and moving my stop loss closer. And each time, because I don't really care if that retracement moves into a reversal, because I've moved my stop loss so far up that once it's moved beyond, say if I've decided it's a 50% level that I want to get out, it's gotten out, but it's gotten out already in profit. Okay, so keep in mind, because reversals can happen at any time, so choosing the best option isn't always easy. So let's go over to some live charts and let me try to show you how we might want to look at them and make these determinations. Thanks. Okay, so now we're going to look at some live charts and see if I can explain this using some live examples. Now, I'm not here recommending any asset. In fact, by the time you watch this, it could have been a week, 2 weeks, 3 weeks, 4 weeks after I recorded it. So just follow along with me, though. I would appreciate it. Okay, what we're looking at right now is the Euro US dollar 30-minute chart. Okay, MACD's on the bottom, but that's irrelevant. If you look at price action, there's really not much we can see. We can see it's kind of bouncing between a level of support and resistance. We don't see any distinguished candles. We don't see any trend in any particular direction. Okay, now most of us trade in a 30-minute or 15-minute time frame. 15-minute chart. If I click it back to 15 minutes, then we see absolutely nothing. Nothing that can help us start determining if there's a possibility of a trade, or which way we should be trading it, or what our entry and exit points should be, or what our stop losses and take profit points. Really, a short-term chart is really a trigger for finally entering a trade after you've made your decision. Now, one of the most important things to realize is that price is random. Okay. Price moves, and I explained this to you before we got here, but it moves as it wants to because it's made up of human beings. But there are certain times that price exhibits a non-random behavior. It's isolating these times and figuring out where you sit in that non-random behavior that you can make sense of the markets. So as we drop back to a 1 hour chart, we can actually see the price is staying very nice between the support and resistance level, hitting this resistance level, bouncing off, trying to get back up there. And now, to be honest with you, we should be looking. Well, let me get my marker on here. We should be looking at a downward move. Okay, but nothing that I would trade on. Now, let's go back a little bit farther. Let's go back to a 4 hour chart because we want to isolate where we sit in this mess. Now, when we look at a 4 hour chart, we can start seeing the price is actually moving in a very nice uptrend. And what it's doing is it's exhibiting non-random behavior. So when price bottomed out here, we can see it pushed, eased, pushed, eased, push, eased, push, eased. Now this is a troublesome point right here because it broke the previous low, but then it pushed back up, and now we see, but now we're stuck between that support and resistance level. But what we have to do as traders is figure out the non-randomness of the price and the price movement, as well as whether we're moving into a retracement or a reversal, because that is cruxed to understanding how we stay in the markets. Because otherwise we panic and jump out too soon, we jump in too soon. So a retracement is simply a small correction as price is moving in a particular direction. A reversal means that that trend is in trouble and it's most likely reversing, or it's going to fall much lower, so you should get in the market, because it could reverse all the way down to a 50%, a 70, a 78%. It can go through several support areas and then turn around and gather its momentum again. It doesn't mean that we should be jumping into a market and shorting it or doing the opposite. It means that the trend is in trouble and we should be watching where our stop losses are, or possibly getting out of the market. Because most people are under the assumption that this is what the market should look like. And if you believe what I was just telling you, this is push. Push, ease, push, ease, push, ease, push, ease. But this is what the market really looks like. So when we can find a period that this is going on, we can then make some determinations. Now, in our previous example, well, if we knew this is what was going on, and this is a 4 hour chart, we're not going to trade from a 4 hour chart, but we could use this 4 hour chart to start figuring out where we might want to enter the market, where we would put our stop loss, and then we have to figure out which direction the market's going to go. I wouldn't enter now, but I would wait and see if it bounced off of this support level, and then I might look for a long trade to stay in the markets as the uptrend gathers its momentum back. Or if I was already in the market, I would be looking at this point to exit the market. Okay, take my profit, or I would be looking at this point to adjust my stop losses. If I understand and keep an eye on this. Okay, this is all the way back, this run to May 16th. We can't trade in the past, we can only trade in the future. So what we want to do is understand what price is doing right now, and by doing that we take that same thing and drop it back into a 1 hour chart. It's not as clear cut, but this is that little piece of trade we were looking at. Okay, and this is that whole segment. So what we've done is we've now dissected that segment, and we can see, the one thing I can see very easily is that we are, and all of us, that we can see is that we are trading between these very strong lines of support and resistance. We drop it back down to a 30-minute trade. Okay, we see less, but this would help us decide exactly when we would want to enter the markets, because we're not going to enter the market somewhere at this point. We're going to wait till something happens at a specific price to enter the market. So what we're doing is we're finding a point where the markets are exhibiting a non-random behavior, analyzing that non-random behavior to start to decide whether we have a long or short opportunity. We then shorten that non-random behavior, determine whether we're looking at a retracement or a reversal, and then we start setting up our trade in our heads. We could at this point actually even set it up in a limit order, giving all of the parameters, or an OCO order. But this gives us a start. But remember, markets don't really trade like that, but there's lots of times where they will exhibit this exact behavior. And it is very important to be able to sort between the random and the non-randomness of the markets. So let's go back to my PowerPoint and talk about this a little bit more in detail. And hopefully you will master random and non-random trading.